Welcome back. Market steady. So it's a good time then to talk about the way forward. Dr. Bino Pathiparampil, the head of research at Elara Securities, is now with us on the show. Dr. Bino, thank you very much for joining in. You've titled your report as Time to Consider Mispriced Opportunities. In a nutshell, take us through the narrative behind this report.
Sure, thank you. As you know, the markets have run up quite a bit. Valuations have become a little stretched. So in this context, we used our proprietary analysis, what's in the price, to analyze and see whether the market is entirely overvalued or are there still pockets of value in the market. So the way we do is we disaggregate the value built into stock prices into the value of current earnings, value of earnings over next 2 years, and the value of earnings beyond that. In a typical average value market, around 50% of a stock's value is the value of earnings beyond 2 years. But today, after the market has run up, it is more than 63%. So that shows the kind of market valuation expansion that has happened in the market, which is almost close to its all-time high valuations. Another interesting point is that the breadth of it is the broader market that is more overvalued than the large caps. So the same metric, which is the long-term growth value for the BSE 200, is higher than Nifty 50, which shows that the small cap, mid caps are probably more overvalued than the large caps. Apart from this overall analysis, we also try to look at pockets where there could be still value. And one area of value that we came across is the oil and gas sector. Names like Oil India, all the oil marketing company names, these are still below the average long-term value. The proportion of long-term value as part of their share price is lower than the overall average. So we still see some room for valuation expansion in that sector, which we find value. In most other sectors, we see that valuations are pretty high and demanding.
So just to, little go deeper in the first point that you made, that now 63% of, on an average, to generalize, 63% of the value is derived from long-term earnings, right? Compared to a much lower number, 50% earlier. In the past, when you've studied the cycles in the market, at what point has the market peaked, according to your proprietary research? And are we close to the markets peaking out or entering into perhaps a no return phase or a low return phase?
Yes, sure. Like I mentioned, we are almost close to the market peak. In the last 20 years, in our analysis, we have seen this going all the way up to 65. So we are almost there already. And plus one more metric that we use is what percent of stocks fall in a category where between 75 and 100% of their value is long-term value of earnings. And that number is also at the peak compared to last 2 peaks of the market cycle. So all this metric and our analysis suggests that the market valuation is close to the previous peaks.
Okay, so valuations looking slightly cautious now given the run-up. Dr. Bino, good to have you on the show today. But the thing is that if we look at the market in the last 12 months, one could argue that perhaps the market also got it right. Along with the euphoria, I mean, that's the nature of the market, right? So when you look at the rise and the rally in PSU stocks or in industrial stocks, it is also here where at least ordering activity is looking good, and in some cases earnings are also looking good. There's some margin expansion. Whereas if you look at, say, FMCG, a sector that has been unloved by the market, that's where earnings support has not been coming in for the last couple of quarters. If you look at banks, underperformance continues, but we're hearing more issues now within the banking space on margins, on maybe, the best of the asset quality being behind us. So in that sense, even with its euphoria, hasn't the market kind of gotten it right? And is there any reason to believe that there could be a turn and a churn in some of these sectors that have been outperforming?
Sure. What you said is exactly the point I was also coming to. If you go one year back and look at the markets, we can clearly see that the pockets of value where there were still earnings upgrades happening where valuation didn't look so stretched. Those are the sectors that have performed, and we have seen money flowing from other sectors to those sectors. Today, if I do that same analysis, we come up with the oil and gas sector, where we see still there is pockets of value. So we could see money moving in from other sectors to this sector. Coming to your second question about the overall markets, as of now, we see this melt up in the market continuing for some time because we have a lot of macro factors, macro narratives working in favor of the market. We have easing inflation globally. We have expectation of rate cuts globally as well as within the country. We have no major growth concerns across the globe except in select pockets. So overall, and domestically, we are getting into an election mode where market expects a good outcome, and stocks are pricing in, PSUs are rallying towards that. So this melt up will continue for the time being, but at the same time, I would recommend people to be cautious about any major event risk.
Sure.
Typically, what happens is when valuations are very high, such event risk can cause major drops in the market.
Absolutely, take that point. But, just to wrap up, let's just talk about the one sector where you do see value, where you do sound optimistic, and that's oil and gas. What's the rationale? One rationale, as you said, that there is value. I mean, the stocks are not trading at the historic high multiples that we've seen. But what could cause them to move higher? There has to be a trigger. Are you expecting, for instance, a big earnings upcycle to play out? What's the trigger for oil and gas? And what part of oil and gas would you be most optimistic on?
So I will touch upon two aspects or two sub-segments within that. One is the oil marketing companies. The marketing margin of oil marketing companies have increased over the last few quarters. But even today, the market is not building in a continuation of those kind of high marketing margins going forward, probably because of some checkered history in the past. But our view is that the strong marketing margins are here to stay and will continue forever, and the market is still in the process of pricing that into the stock prices. And once that happens, we see earnings upgrades as well as valuation expansion.
Okay.
Similarly, in oil exploration companies, especially I would highlight Oil India, where there are significant upsides coming from a new gas pipeline, which will connect their mines, new explorations opening up, which can add to volume growth, etc. All these are not fully captured, which will lead to earnings upgrades as well as valuation expansion in our view.
Okay, great conversation. Thank you very much for highlighting your report and taking us through it. We need to slip into a very short break on that note. On the other side, market technicals, Vishal Malkan will join you next.